we're going to get some data today the market's been waiting on all week. This hurry up and wait is very likely going to end. It's ready. I'm ready. I'm ready for it to be done. Let's break some ranges and get going. Markets won't sit in the hurry up and wait category forever, right? Sooner or later, they're going to wash it just because they're tired of waiting, or they're going to wash it because we finally got the information that we're looking for. We got a little bit of the MAG7 reporting, and if this is a tell for how the rest of it's going to go, it's not going to look too good. I mean, Google had some good numbers, but they spent $1 billion plus more than they were supposed to spend on their AI development, and that's what it took to whack Google down. Tesla's in its own little category, but it missed, not really missed, it is postponing a lot of things. The new construction in Texas, the robo taxi unveiling, the cheaper Teslas that they were supposed to roll out. It just goes on and on. The robot that he had been promising is pushed back. So big misses in goals on Tesla. The self-appointed goals that he had anointed for himself, and then with Google, just a big money sinkhole when it comes to pouring more and more money into AI and AI services. Yeah. Yep. And it just goes on and on. I haven't even gone through the entire thing yet, but if we see a lot of the other MAG7 reporting saying they're spending a lot of money on, building out AI and they're not getting anything for it. I was listening to a Meta interview where they were bragging that their AI is going to be the most widely used popular version, and they're like, well, what makes yours so great? His answer was pathetic. It was something like, well, as you type, it's showing you the pictures of what it could be. That's it. That's as good as you got. You spent a couple of $1 billion, and as you type, it's showing you pictures of what you could get. You got to do better than that, bro. For a couple of $1 billion. Anyway, NASDAQ down 1%. Exactly right. You know what I mean? Like, and they're all still using restricted data, and they never mention Microsoft with AI. I was using it this morning. We're going to get PMI data today. So U.S. manufacturing index is today. What's the anticipated forecast, and what is the anticipated market reaction? I just asked AI, Copilot. I have the forecast, 51.6, equity, bond, and currency impact anticipation for whichever one of those we get. Back up a little more. We got a rate cut from Canada today. What's the projection? What are they expected to do? And how is it expected to hit the market? Laid out nice and neat, just talking to AI. We got Bowman this afternoon. Where's she talking? Is there going to be Q&A? Will there be a press release? All laid out nice and neat by AI. Useful, effective, concise, up to date. Pretty pictures. I can do that with Midjourney. You know what I mean? That's yay. So NASDAQ down 1%. S&P down more than 0.5%. They are flattening out along the lows, like a little bit of a basing pattern, but with Canada on deck. And then the other data that we're going to get this morning, that doesn't have to be the end of the move, right? We can be building out a base before expanding lower. Japan down 0.5%, the Dow less than 0.5%. And then the small caps around 0.25% to the downside. Hong Kong up the most at a minimal 22, not even 0.25%. As you can see, Wednesday's kind of full. We got a lot of stuff here. Bowman's going to speak late enough in the day that it isn't going to matter. At least it isn't going to matter to the market today. It might matter in Globex tonight. New home sales is not to be dismissed, but the big one is going to be Canada and its rate decision, and then the manufacturing PMI services. We do have auctions today. We got the 5-year at 1 o'clock. And as I've said before, if you have an auction anywhere at 11, 11:30, or 1 o'clock, just assume that the other time frames also have an auction. So we have one at 1. Just go ahead and believe that there's one at 11 and at 11:30, even if there isn't one listed. There is data that comes out every day that does not get listed. And just because it's not listed doesn't mean it isn't important, because QRA is never listed and it's really important. And if that's not on there, what else isn't on there? I point out finance use all the time. I don't get anything for it, right? I'm not affiliated with them. They're not paying me to talk good about them. They're just a really good place to go. You don't need an account, but I highly recommend you get one. It's free. It doesn't cost you anything to open an account. Having an account allows you to filter what news it shows you. This is a news aggregate website. That just means that it's getting news from multiple sources. And if you have an account, it will remember your settings so that you can go in and filter out the news that you don't want to see, like CNN and Fox Business. I don't know about you, but I don't want to listen to that trash, right? MSNBC and all that noise. I just remove that from the feed so it doesn't clutter anything up. These guys give you a US session prep, kind of a morning briefing before the day starts. And after the market closes, they give you another one, a market summary. They do it for the US markets, the Asian markets, the European markets. So you've got a really good idea of what the heck happened today and what is expected to happen today. What's on the books? What is everybody focused on? It's a short read. This is not like, some big book that we have to read every day. Just a quick glance gives you set up. Anything that they deem relevant enough gets added to this. So if you're not checking it out, why not? Maybe you're just so good you don't need the hand. I'll take the hand. Give me a leg up. And you can't meet free, right? I have a paid version, but you don't have to have a paid version. We got the founder's note from last night. We don't yet have the AM notes. Vol Signals, which is a different company we don't talk about very often, they were sending out an email how there's been a very large SPX trader in the last few days, and they've had Monday and Tuesday just perfect, massive iron condors, and they were putting them on before the close. So Friday there was one for Monday, Monday there was one for Tuesday. They didn't put one on last night. Another indication that we aren't expecting the range to hold another day, right? We got the 2 days of wait. We're done with it. We're ready to make a move. That's just one more signal, right? As if we didn't have enough signals that it was very likely the end of the range and that it's time to go. Right now, we have Friday's low as the low of our boundary, and we have Tuesday's high as the high of our boundary. That may seem like a lot, but that's not very much. 56.32 is the cog line. 55.42 is the other end of the range. So we got like a 90-point range there. That's nothing. We can easily negotiate that range and get beyond it. We really don't have any voodoo lines of note. The white one is all the way down here, and the green one is much farther away. So, anything impactful, nowhere near us. Looking at the floor pivots, we're still completely underneath the weekly pivot. We've expanded away from it nicely. And at this point, we're not oversold. We're not to that point where we're so far away that we would be thinking about mean reversion and at least squared methods, dot plots, and standard deviations bringing us back the other direction. We're just not oversold enough, not even close. The floor pivot for the day is higher than the previous days. I turned the channel off, but turn that back on just to see if it's narrow or not. It's narrower, we can say that. It's more narrow than the previous day, but it's not as narrow as I would like it to be. A narrow channel implies that if we break out, the breakout could have legs and we could really expand. That does not move price, right? We just want to continue to reiterate these channels and these floor pivots. They don't make price do anything. They just give us an idea of what to expect from price. The spot gamma index closed back in a positive range, 0.479. So call it 0.5. We're in positive gamma, barely, and we're really close to the gamma level, which we'll see when we get over onto the spot gamma side. We are beyond the S2 level this morning, but it's worth noting how narrow the SNR range is, right? We've talked about this before when you're looking at floor pivots. When we got SNR levels and the levels are really close, it's easy for the market to go to an S2 or an R2, S3. This looks like a very noisy, very loud chart, a lot of stuff all over it. But if you focus on just one particular day, like that day, this was a very wide range between its R3 and its S3, right? Just see how massive that is, from 5550 to 5800. Getting to the S2 that day was a really big deal because, man, we really made some moves. But look at the range right now to go from an R3 to an S3. It's a much smaller range. Everything is constricted because we've gone sideways the last few days. So sure, we're beyond the S2 this morning, but it's a very narrow range. So it was easy to get to an S2, unlike back here where we had an S2 level that was just really far away, right? Or here where we had an S2 that was really far away. So can't read too much into those on the first shot, just just by looking at it and saying, oh, look, we're at S2. Yeah. Do I think it holds today? I mean, that's like you're making a bet on which way the market's going to react to an FOMC event out of Canada. That's a coin toss, bro. That's like trying to guess what earnings are going to do. I wouldn't want to guess. I don't do good when I guess at earnings, that's for sure. If Canada cuts like they're supposed to, the market won't be surprised. We shouldn't get any big numbers. And then if the data from manufacturing comes in as anticipated, then we shouldn't get big numbers. But the market's been going sideways for 2 days waiting on this data for a reason. The expectation is that we might get something of a surprise. And if we're surprised, the market could react violently and no SNR level is going to hold. Just like when we get PMI and non-farm payrolls, FOMC, CPI, those pivots and levels don't mean nothing in front of economic data. We are already at the ADR half. Generally speaking, if we get there really early, we can go to the other side by the end of the day. I've got some great footage that I've cut out over the years. I should just do a montage of all the times I've said that, where we've gone to the other side by the end of the day. It happens, right? It happens enough that it's worth considering. The other side of it though, and we did get to the ADR half really early, right? We got there late last night or early this morning. But this time's a little different than normal because a lot of times when we get there, we tag it and give like a V bottom and then we go the other way. We got down there and we held it, been consolidating around it. We've seen this before too. And what happens a lot of times is from here, we leg farther away and continue the move. It's not guaranteed to happen this time because, again, we've got data, and trying to guess which way the market's going to go in front of data is kind of pointless. We do have heavy volume this morning. They are trading, but they're not hedging, at least not yet. We want to continue to look for a market maker move and see if they do start to hedge. That'll imply that the wait is finally over. And we're not 100% sure that today is the day the market has been sideways waiting on. I kind of feel like it is. It seems like the buildup has been leading to this point, but what if it's not? And the fact that we don't have the market maker move kind of implies that maybe it isn't. There may yet still be another thing that the market is waiting on. I'd feel better about it if we saw a market maker move up here that would tell us that they're hedging because they're worried about an upcoming event and that we're on the right track. Since we don't have that, we'll just have to believe that maybe it's still a bit early and that they're not hedging heavy enough yet for it to show up. Yeah, they are in there this morning. 7,500 on the call side. Not yet, right? Not yet, simply because of the data. We had another gap that needs to be filled, and it's this one back here, right? This still hasn't filled yet, even though we got close. And when we opened gapped up from that, that was a really big gap up when we got into RTH. And I thought for sure we were going to get down there and get that gap closed, but it didn't even come close, right? So this morning we're down a lot. We're getting a little bit of a mean reversion. And so the gap is there. We're down 0.75%, but we got to get this data out first, right? So on the SPX, we're still in positive gamma. On the ES, since it's been open all night, we're below that 0 gamma, below the volatility trigger. And the put wall has been moved down to 53.45. That's a bearish signal overall. Just the fact that they rolled it down is a bearish bias. So we definitely want to keep our eye on that. And on the call wall, which, you know, it seems like the call wall rolled up, but I'm going to have to wait for, oh no, I don't have to wait. I'll post, they got this really ugly chart that is in the founder's note. If you scroll all the way down to the bottom of the founder's note, it's 4 lines, 5 lines. It has the volatility trigger, the SPX price, put wall, call wall, and gamma index. Looking at that chart, which I will post a picture in the chat for people so that they can see it, even though I already shared the founder's note. The lines show what rolled up. So the call wall rolled up. It shows the put wall rolled up, but we know that it's down. And then gamma index is up and the volatility trigger is up. So we need the AM one. That's what it comes down to. We need the AM and see what the new numbers are. And we don't have that yet. We don't want to try to anticipate the market's reaction to the data today, right? Whether we're going to get the gaps closed, we're going to break Friday's low and go lower, or Tuesday's high and go higher. There's no reason to guess or assume yet what the market's going to do. Let's get this data first. And like when we get other data, CPI, PPI, non-farm payrolls, we have the opportunity for a liquidity gap. I wasn't really anticipating talking about a liquidity gap this morning, but I've done it enough times that I think people kind of got the feel for it. It's just the idea we're looking for a very large candle. The candle from the data point, say 8:30, 10:30, whenever we get the data. The first initial move needs to be a move only in one direction, up or down, doesn't really matter. And once we get that move, then we'll look to reciprocate it in the other direction and get the gap closed by 11 o'clock. I was hoping just a quick scan through would show an easy one to point at. Normally I've got them all saved in pictures and I use those, but I've shown it enough. I think everybody got the idea of what we're looking for. This big move, for an example, I know it doesn't seem very big because I zoomed in. That very large candle, we want to take it back to where we started. Now this gap was closed in like 20 minutes. Generally, the 8:30 print doesn't get closed until around 10:30, 11 o'clock. But it can happen really fast like it did here. With the data that we have on deck today, we could get another really big move that just gets washed right back out again. This looked bullish. It looked like we were going to really take off and make moves to the upside, but instead, we not only got the gap closed, we went lower. So we could go either direction. We could start the move in one direction and finish it in the other. And don't forget the statistic that says no matter how bullish, no matter how bearish, in the first 30 minutes of the regular trading session, the market can change direction 50% of the time. That is literally a coin toss. No matter how bullish we are when we get into the regular trading session or bearish, it can flip in the first 30 minutes. 50-50 chance. Those are some sorry odds, right? 50-50 coin toss that we can change direction when we get into the open. So at this point, if we break our own low, this 55.50, which it is a gamma level, it's an options level. Even if it's not marked, we know round numbers are traded in the options market. Break that 50-50. If we do it on our own without econ, then it puts the full ADR in focus. We can break Friday's low, it puts that ADR full in focus. If it happens on econ, and we get a big candle like we were just looking at, then we're going to expect the gap from that candle to be closed. We've still got the point of control overhead. We're not looking for that to change anytime soon. This is the 10-day, 30-minute volume profile with TPO. That point of control is not going to move for days still, unless we get some massive volume at this new level, and that's not expected. We're not even expected to stay here very long. It is a significant resistance overhead. 56.50 is going to be hard pressed to see price get through that level. We do have a new VPOC from yesterday, so any move to the upside is going to have to take that into account. It's on the COG line, 56.11. Imagine that. You know, I keep getting questions about the COG lines, how they're derived, where they come from. And it's a ton of work to validate cog lines. And I quit doing it in the SPX when we were still at 3,000 something, because I just got tired of spending weeks and months validating each one of these levels. And I just started assuming that all the 11s were a cog line and all the 32s were a cog line. And I continue to be validated myself because I continue to see things like this, where we get, the massive amount of trading yesterday. Where's all the volume? Right on the cog line, 56.11. Where's the next one above that? It's also a weekly range and a weekly halfback, 56.32. It just continues to prove itself again and again and again and again. I'll take it. Save myself all that extra effort and work. We did come down and tag this 51.50, or at least we got really close to it. It's still in play. Until we get through the other side of it, that VPOC is still in play. It's on around number 55.50, so we already have that in our focus, even if we didn't have the VPOC line, but we'll take it, mark it anyways. That was a really great signal yesterday of just the compacted market nature, right? And the fact that they didn't put another iron condor on kind of implies they're expecting the move to finally begin to expand. I think everybody is expecting the move to finally expand. But what direction? First blush would be that it's going to be to the downside, so that we can go ahead and get that 6.5% move that we were looking for, like we got last quarter. But so far, we don't have it, right? We're not even 3%. Yeah, 3.09. So another 3% at least to the downside before we would call this pullback done, if we're going to actually get that pullback. We're still above the 10-week, but a lot closer to it than I would like. Think about how we were doing from QRA in November all the way up through April, just holding above that 2% really well. It's just a good, dominant, solid, steady market. And we don't have that. We're underneath the 2% mark, getting closer to the 10-week. Keep in mind, all we have to do is go sideways, right? The 10-week will come to us. We don't have to go down to it. That's a correction in time rather than a correction in price. But we are getting a correction either way. We're getting closer and closer to it. That's just a bit of a reset. Get us back to the center of the court. And then we can move 2%, 3% in either direction from there. Well, we're not even there yet. We are below the 10-day, close to 1%. We were beyond 1% to the downside earlier. So we're kind of working our way back. When I zoom out, you can see how often when we are below the 10-day moving average, how it goes like a jagged jack-o'-lantern. It's not some nice smooth move like a MACD kind of curve. So, expect these gyrations to continue. We went down deep and then we came back to shallow and then down deep again. It can happen multiple times before we finally get back above again. Unlike the weekly one, this tends to be a lot more janky, right? Moving around all over the place, cutting into both sides. It's the daily. We are back to Friday's close. We talked about that gap fill and how Monday didn't fill the gap. Well, we filled it this morning. So that one's closed. Now we just have this gap up here to deal with. And it will fill it eventually, right? gaps fill eventually, but how long? So when you think about it, if we're right back to where we started the week or how we ended the week last Friday, then those iron condors playing the range, you know, I love it. I didn't do it, but I love those weeks where we know we're waiting on something big, like we're waiting on CPI or we're waiting on Nvidia earnings or something like that. The market will literally just sit there for 2 days, Monday and Tuesday, doing nothing. And it's just a really good way to play the market because you don't need the move to get paid in options. You can get paid for not moving. But the week's range is still there. And we've made an entire week's range move in a single day many times before, right? So just because that's how far we were supposed to move in the entire week, don't think that we can't make the entire move in a single day. There's been many examples where in one day we've gone from the midline all the way to the top. And there's been some examples where we've gone from the bottom line very close to the top line in 1.5 days or even just one day. So big moves can happen. There's a couple of examples where we were on the midline, Friday's close, and we ended the day above the channel. So another one back here. Here's going the other direction from the top of the channel back to the midpoint. Same thing. So it can happen, right? The longer we stay sideways, the more energy this market is building up. I know that's not a phrase we generally use in the market, energy. But using that RSI Laguerre, we have figured out that when a market is going sideways, it is building up energy. And when a move does happen, we don't have to automatically assume that the move is spending that energy either. Because sometimes when the market moves, it's building energy. So we're wound up, we're ready to go. We got full of juice. You know, the battery is topped off, or the gas tank is topped off. The base case assumption is to the downside. But we got to get data before that sticks. So without data, say the Bank of Canada today and the PMI services manufacturing, neither one of those cause a liquidity gap, and we just have business as usual. Then what? My focus at that point would be to play what we have left, right? So just clear all this off. We can always just measure our own range. We can run that in both directions and plot those out with, say the 111 and the 1.236. We can run them both directions that way. 236 gets us pretty close to the RTH low of yesterday. We got multiple pivots from yesterday to deal with. Got the Globex low, the RTH low. There's even the halfback from Monday And then, of course, there's the half back from yesterday. So we've got levels that we can play. And for a downside expansion, it's like I mentioned earlier, from Friday till Tuesday. That's what you're going to want to measure if you're going to project to the downside. You can add in the 111 and the 1236 just because of the distance we've got to move. But then you got your half and your full. And you can do that in both directions. Clear levels, play it till it breaks. One of the levels that we were playing earlier this week was Tuesday's midpoint, or excuse me, Thursday's midpoint. And I got a number of people that reached out and asked, how far back do you go? I think they were a little surprised that we were using Thursday's data on, I'm pretty sure it was Monday. We go back as far as we need to, right? On Monday, we had Friday's data, and it was the first candle to the left, so it made sense to use Friday's data. But if you had looked on a daily chart, Thursday was a really big day, right? Thursday's the biggest day. So on Monday, when we were trying to figure out how far the market could make a move to the upside, once we broke out of Friday's range, it made perfect sense to measure out Thursday's range and figure out where the midpoint was. And I mean, it seems like a good idea. It worked. It gave us that insight on where the market was liable to have some issues. Sure enough, it had issues. But this whole leg can be measured. $56.31 cog line. It just comes up again and again and again. All the 31s, all the 11s, all the 92s. So I like this range the best right now. That key level 56.32. We got to get through that half back if we're going to make it. This is a half back rejection. We weren't able to make it through yesterday. It's exactly what I called it yesterday too, is a half back rejection. Wasn't quite expecting the gap down as big as we got, but we'll take it. So project that in the other direction too. That would get us below this level, and it would give us that lower low that we were talking about in the pure price method. We need that lower low. Breaking this low won't necessarily count from a pure price method because we didn't pull back far enough away from it to make that a distinguishable pivot. Some analysts will call it a low, and then when we pull back and we come through, they'll count that as a new low. I'm not against it. I just think that this wasn't a far enough pullback. Otherwise, we'd be counting something like this as a low just because we went up a little. And, you know, we wouldn't do that, right? This whole thing is structure. So from this pure price method, the pullback that we have here, we've got to get lower than this so that we can start that new low, lower low process. And we have to get a lower high. This doesn't count as that lower high yet. Because again, we could just stay here and chop about and we'd still be looking for that lower high somewhere. Right? Like that doesn't count as a lower high from there. We're getting some moves in the dollar and in the 10-year. more the dollar than anything else. At first blush, we would think the dollar going down should be useful for the S&P and the NASDAQ to go up. But I started pointing this out last week. Don't default to that basis, that bias that says, oh, the dollar's going down. I think the S&P is going to go up. Look at what's happening right now. The dollar's going down. The S&P and the NASDAQ are also going down. We're losing that inverse correlated state. Generally speaking, when we see the 2-year and the dollar making a move right in front of econ, the base case argument is that the market is front running some data that it knows that we don't. That's what I'm thinking. You know, for those who can't read the chat or watching this later, maybe on the replay, the statement, it was, so bad news is bad news. It hasn't been, right? For a while, bad news has been good news because then the market believes it would force the Fed's hand and they would cut sooner. So bad news was good and good news was bad. But at what point does that dichotomy change and suddenly bad news is actually just straight up bad news and then good news is good news? I think we're getting a lot closer to that point. This 3 grid is something that I tend to look at as we get into an economic event, CPI, non-farm payrolls, whatever. This is my go-to screen as we get closer and closer to it. And I have seen that front running in the market where the dollar and the 2-year will both go up before the event, or the dollar and the 2-year will both go down before the event. And very often it is a accurate precursor. I never trade that though, right? It's not like I'm going to go long the ES just because these two are signaling. Maybe if I was in paper and I don't care, right? Just to do it. So what? It's paper. But trying to second guess the move of the market based on economic projections before we even get the data seems like a trip to Vegas, right? And at least in Vegas, you get free drinks. So I'm not interested in trying to guess. But this does make it seem like the data we've been waiting on is today. Remember, we were just talking a few minutes ago that since there's no hedging, we're not quite sure that today's actually the day the market's been waiting on, Monday and Tuesday. It could be something tomorrow or Friday. But seeing this now gives me a little more confidence that it is today's data, whether it's the Bank of Canada data or it's the manufacturing data, either one. And it doesn't really matter at the end of the day which one of those two it is, as long as it is one or the other. We're finally getting a little bit of a move in crude the other direction, but I wouldn't lean too heavy on that one yet either. Remember Wednesdays, we get crude data, so 10:30. If there's nothing else to play, maybe go take a look at crude. And like I was talking with somebody yesterday, I know crude and gold are big. You know, it's $1,000 a point, but there's micros on crude and gold, and the crude options are now 5 days a week, started this week. I was looking at the options chain. It looks like they come out next week, but the data came out this week. CBOE is offering 5 days a week on futures options for this thing. Fantastic. Not for the MCL, but for the CL. So if we don't get anything in the NASDAQ and the S&P again for the 3rd day in a row, maybe take a look at gold or crude. There's always something. Semiconductors are down. Nat gas, the MAG7. The S&P versus gold ratio is down. May want to go take a look at gold, circle back. Spot gamma SPY growth is down. All right, the AM just came out. Let's see. Of course, I'll get it shared with everybody later, but just for now, let's get those levels because we're not expecting the things that are up or the things that are down to stay this way once we get data. That's why I wasn't too quickly interested in looking at what the econ was for equities. SPX support 5500 and 5517. Resistance is 5550, 60, and 5600. Their range for the day, 0.6. We were already there, right? We already made 0.6. We're at 0.8. They're giving Tesla and Google negative 25 basis points of index pressure. Add in Meta with another 2.2%. That's 30 basis points of negativity. So they're calling a flash crash below 5,500. If we break that, they're calling for 5,400 fast. I like those fast moves. We get down to 54 and see the options market come in, with a bunch of put selling around that level and get that V bottom knee jerk reaction halfway back up again. That'd be a nice move back into like 54.50. And as I reference often, the spot gamma index, we're back in negative territory, minus 0.5. This goes from -4 to +4. When we're in positive territory, breakouts tend to fail more often than not. And when we're in negative territory, breakouts tend to grow legs and really expand. And that comes from dealer gamma, right? When we're in positive gamma and we break out, they'll sell into the buying. So as we rise, they're selling. And as we fall, they're buying. But if we're in negative gamma territory and we fall, the more we fall, the more they sell. The more we rise, the more they buy. So if we're rising and they're buying, we'll rise even more. If we're selling and they sell, we'll sell even more. We'll fall even more. We're in negative gamma. We're barely in negative gamma, but we're in negative gamma. The breaking point is the level we want to really focus on. At what point would they really engage in that selling and really sell into it? That would be that 5,500 level for the SPX. $57.95 for the ES is the call wall, and $53.45 is the put wall on the ES. As you can see, we're a long ways from that put wall for the ES 53.40. So we'll see. Could be a wild day. Let's get that data print first. See if we're going to get a gap close. Candle setup. And then we'll play the ranges from there. Everybody be careful. Be safe. Have a good day. I will see you all tomorrow.